All right, guys. So basically, the concept we want to talk about today is a very important concept when it comes to trading. As a matter of fact, always tell beginners or traders whenever I have opportunity to, more especially those who are just coming into the space of forex and you're trying to learn and find your foot, especially as it concerns technical analysis. The concept of support and resistance is the foundation, is the bedrock of trading. Like it is something that you must know. And as simple as it is, you can actually trade with only this concept. Okay. So the concept of support and resistance is something that if the intention is to actually do numbers or you want to actually grow in this business, you need to understand it very well and you need to know how it works. So every strategy we trade in forex, be it no matter the strategy at all you trade, everything is gotten from support and resistance. And everything, all strategies works because of this concept. Because if you're trading reversal, if you're trading continuation, reversals has to happen on these zones. If market is not at a very important support or resistance zone, even if you're projecting or forecasting a reversal, the chances of market respecting that zone and going in your direction is very slim. Okay, and that's why it's very important when you understand how to do this and draw its killer support and resistance zones on the chart. You've not only succeeded in equipping yourself with the necessary skill you need to do exploit in this market, but you have conquered over 60 to 80% of what you need to know to be profitable in the market. Okay, so when it comes to support and resistance, support is simply a zone or a price level on the chart where price gets to and reverses. So if you take, for instance, you're with a football, let's say you're with a ball, the football right now, and this happens to be floor, and you're standing on that floor, right? If this happens to be a floor and you're standing on it, if you bounce that ball on this floor, what is going to happen? You throw it on the floor. What will happen is the ball will touch this floor, right? And it will bounce up again. The same thing happens in the markets, right? If price gets to a support zone, like for instance, let me start with this. So if price gets to a support level on the chart, this is what is going to happen. Price will touch that level, and immediately it gets to touch that level, you're going to see reversal from that zone, from that level. Okay. Now, in reality, this does not really exist in the market because in reality, what we have in the market is zone of price reaction. Actually, a particular level where price is finding it difficult to break. So this could be the level where the market is finding difficult to break. So when you draw one single line, you're just choosing like you're by implication saying that the support zone is just a price level, a price level. But in actual fact, if you traded a live account, you know that what exists in reality, this market may have done this in the past, come here and reverse, come back again on the zone, reverse, come back again here, reverse. So in summary, you're trying to get the aggregate price reaction on that zone, the range of zone where price is actually bouncing from. So it, the technical analysis is not an exact science, but rather it is a probabilistic science. And what you want to do at every point in time is to catch the most reaction, the zone where this reaction is actually happening. And when drawing this, you try to capture as many touches as possible to ensure that your support and resistance is actually a killer level where that reaction is taking place. Okay, so support is just price levels on the chart where when price gets there, if market has been going down, like it has to be going down, it has to be in a bearish movement. So once market gets there, you expect the opposite to happen. You expect the opposite to happen. You expect price to bounce from there. Okay. If it has been going down, it goes there, you see it's reverse. And that is how we get our area of support zone. Okay. So as support zones, what you see is that you see more activity of buyers at support zone. Buyers are the ones that actually help support zones to hold because they are looking at executing their trades at support zones. Now, this is areas on the charts where market is actually reacting. Resistance, on the other hand, this one exists at highs, and the market has to be in a bullish run to test a resistance zone. So let's say, for instance, we are looking at a price level like here, right? And just like imagine yourself standing in your room, you throw a ball to the ceiling. What will happen is that when the ball hits the ceiling, it's going to reverse. The same thing happens in the market. When the market hits an area, a price level where you have concentration of sell orders, the price is going to reverse. Okay, so as at resistance zone, you expect the market to meet a barrier of sell orders, and that is going to help it to reverse. So there is the activities of sellers at this high that causes the resistance zone to hold. So just like support, you know that resistance equally is not a single line or a single price level on the chart, but rather is a zone of price reaction. So you try to capture the most touches on that zone, and that has formed your resistance zone. Okay. Now, it's very important to know that in actual facts, these two zones interchange roles. If market trades into an area of support like this, like you see market moves into an area of support. If this support is broken because there's nothing that is concrete in the market creates support and resistance zone to eventually break them. So when support is taken out, it becomes resistance. And this is actually what has played out on good, this week. So an area of support broken, that the market is going to come back to confirm that zone as the new resistance before it continues to go down. The same thing happens in the event that we see markets take out resistance. If market trades into an area of resistance, rejects off it, come back to that zone, consolidate a bit, and eventually take out that zone, market is going to come back to retest this new resistance. Resistance broken becomes the new support. So once the market confirms it as the new support zone, is going to bounce to the upside. So the summary of what I'm trying to say here is that when support is broken, it becomes resistance. And when resistance is broken, it becomes support. Okay. So what I've tried to explain here is this type of support and resistance zone, because static or horizontal support and resistance. So these ones are support and resistance that are just static on the charts. Now, this one you have actually seen here are price levels, swing points in the market. Swing points in the market where market is actually turning from. That's how you get these support and resistance zones. Now, there's another type of support and resistance that is equally horizontal and static, and that is called psychological levels. Okay? Psychological levels, these swing points are all under static and horizontal support and resistance. Now, psychological levels are double zeros and 50s. So when you go to price levels, this is chart of gold. If you are looking at what price are we here, all right, the double zeros are 2,000, 3,000, 4,000, 5,000, 6,000. Then the 50s are 2,500, 3,500, 4,500, and so on. These are psychological levels on the chart. So there is a price range where an asset will get to, and it's going to trigger a psychological sentiment on that asset. It's just like when dollar to naira touch 1,000, it was a psychological level for a lot of Nigerians, and immediately it touched 1,000. If you analyze that, you see that there was a sharp reversal. Eventually came back to take it out and continue. The same thing happened when we got to 1.5. So those levels are psychological levels that attracts institutional traders, they always take the opposite move. If you go to GU, most times you still see it. It happens time and again there. Now, coming to this guy, which is dynamic support and resistance. Now, just like the name implies, dynamic, this one's move with the charts. If the market is going down, you're going to see it go down with the market. If the market is equally going up, you're going to see it go up with the market. So if you're looking at a dynamic support and resistance, you're talking about trend line. It works only when the market is in a trending phase. If the market is not trending, there is no business between you and dynamic support and resistance. So what I'm trying to say on this dynamic is this. If you're in a bullish market environment, I see that the price is pushing up, right? Most times there's always a specific zone where the price is coming back to. So when you put a line here, you see that you have a trend line support. So this is what I'm talking about. So this is a dynamic support zone, all right? So after the market take out this level, you're most likely you're going to be looking for buying opportunity when next market come on this trend line. And this is where you want to buy, okay? So this is how dynamic support zone works. Now, on the flip side, if you're looking at dynamic resistance, you use it in a bearish market. The market is in a bearish trend. So that's to say that you have to see the markets creating lower lows and lower highs in this order, all right? And all you need to do is you put your trend line. So for those of us who don't know how to draw this, we're actually going to be looking at this, one of the classes, how to draw effective support and resistance zones. So you have the first touch here, second touch, and of course, on the third touch, you are trading it. The return to this zone is where you tend to take the trade to go down, right? So this is the dynamic support. This is dynamic resistance, okay? Now, how you use these things to trade is you model reversals around static support and resistance. You look for reversals in confluence with this. When you're looking for reversal, it makes sense to, in fact, you use static support and resistance to trade reversals. I use dynamic to trade continuations. What I mean by reversal is, let's say we have these two zones like this. This is a resistance zone. And of course, this is a support zone. So let's say we have these two zones like this on the charts, and market is coming from this zone. If market is coming from an area of resistance, you see it going down, right? You already know that the market moves from zone to zone, from resistance to support, support to resistance. Now, when market gets here, what we expect this market to do is when it gets here, it should reverse from here and come back here. So that's what I'm trying to say, that you model reversals using static or horizontal support and resistance, okay? So we're going to be looking for reasons to buy from here. I will expect this market to continue to go up, right? From here, after that, till it gets to this resistance where our TP will be. But for dynamic support and resistance, we use it to model continuations. So if the market is already in a trending phase like this, you know that the market is already showing you sign of bullishness, okay? But right now, you are looking to join this trend. But the question is, where do you enter the market? That is where you now apply dynamic support and resistance. So you're going to be waiting for this market to come back here, exactly on this zone. This is where you now join the trend. You model your buy from here. You get it targeting this high. So why we use this guy to frame reversals from bullish to bearish, from bearish to bullish, we use this guy to frame continuations to join a trend. All right. So let's go to the chart and I'll show us how to do these things live in the market. We're starting with the static support and resistance. So basically, Support and resistance exist on all time frame. Like this is good, daily time frame. The chart of gold on the daily time frame. Now, you can draw this on all time frames. You can do it on daily. You can do it on weekly. You can do it on lower time frames. But my advice is this, right? If you're interested in trading using this way of analysis, do it on higher time frame, but especially starting from the daily. So from daily, weekly, and above, that is where the tendency, the efficacy of it working is seriously high. You use it to model reversal around those zones. You have serious pips to catch while targeting the next support or the next resistance zone. All right. So the very first thing we are going to do on this before marking this is you establish the scope, which is exactly the zone where you want to analyze from. So let's say, for instance, we're interested in analyzing this market from the lowest. Okay, let's start from here. Okay. So you establish where you want to analyze from. You're not really be interested in analyzing everything. So from this low to the current high is what we are interested in. This current high here, all right? So let's say we want to know the dynamic, in fact, the horizontal support and resistance on this chart between here to this place, where the market have higher chances of reversing from. So the very first thing we need to do is we pick our part 2, and we're interested in all the swing points. All right, the point of reversal. So you're going to put here, the market gets to this high. We see it come back to this low. And of course, it went back again to this high and put this low. Okay, so these are points of reversals. From there, we saw the markets move from this zone back to here, then here. All right. So all these points of reversals, you can put dots in there. So this is it. All right. These are reversal points, reversal points, reversal points, reversal points. And of course, this. From here, we saw the markets put up this low. And of course, this high and this. So got this low here. So once we have this all defined out, so we already have a line here. We double this line. Okay. Now, this is where the whole job, the job is done. When you mark this zone like this, the very first thing you need to do is, we took our zone from here. We're going to open this zone, open this level very well. And what you want to do is you want to catch the most reaction on this zone. So this price level traded as low as this. And of course, we saw it, so the most touches on this zone will look like this. So this is a support zone. This is where I want this support zone to be. So you got it here, touch here, 3 touches. All right. So you zoom in completely and you go back in time to check. You need to confirm if price have not respected that price level in the past, you may not want to put it on your chart. Very, very important. So you need to, unless that price level is either the all-time high or the all-time low, that is, price has never traded on that zone before, but a bounce price. Okay, so you go back in time and check if that price level has been respected before. Now it looked very well. The market almost got here reversed. So I'm going to extend this a bit like this. And of course, you have some level of congestion here. So I'm going to stretch this up a bit. So I'll leave it like this. This looks more like it. So this is a better zone for me. Okay. Now, I come back to this high here. So this is the first touch, second touch, third touch. So it's already a strong resistance zone. So I'm going to put double line here too. All right. And that's it. So once you put these things, to make it a support zone, you're now going to insert a horizontal . You now insert a rectangle inside these zones and you delete the lines. Very, very important. You take out these lines, okay, and zoom out complete. So once you have this, you move this, you copy this, and insert inside this one. These are zones of reversal. You take out this one, you move this to the next. So this was a liquidity run on this one. So this is not going to be a valid. Okay, take this out. Then of course this one. So this was a low at a point. You double the line to get the most touches there. This was a resistance at a point. Double the line. Get the most touches there. Boom. Okay, so we had another one here. So you open up this level very well. Now, why I'm not going back in time to check is that all these were all-time high at the point. Gold has never traded in this price level before. So you just created these levels new. Okay, so the market retraced here a bit. I gave this price level. So we have another zone here. So it looked very well. This is this. This guy equally retraced here. Then you have another high here. Okay. Now, one of the things you want to avoid is this kind of scenario where you have levels very close to each other. All right. It's going to be quite difficult for you to actually frame a trade on this. So what I'm going to do now is I'm going to streamline this exactly on this zone, this like this. All right. And I'll copy this, put inside here. We'll take out these lines out. Put this on this. Of course, this. Okay. So basically, this is now the zone I want to work with, right? Now, when gold is coming back on this zone, I expect a reversal either here. You see, this one has been taken out. Market actually came to this zone, right? You see, it broke it with this candle and retested it with this candle. You see how it wicked inside and now closed back. So the next point of interest is actually this low, right? This support zone, resistance turn to support. You know, the market, it was resistance here, broken, becomes support, support, boom, it went up. So when it came back, it comes back on this zone. I expect this zone to hold. So what are we going to be looking for here? Right now, the market is already bearish as a result of taking down this low, but we expect the correction to start happening from here. So you expect this market to either correct back to this for continuation or thereabouts. So this is the next zone we are going to be modeling buy side of from here. So this is basically how you use horizontal supports and resistance. You mark it on the chart. And these zones, they work very, very well if you take your time to mark them. They do magic, honestly speaking. So irrespective of the strategy you trade, if you start looking for setup on that strategy at a strategic point in the market like this, there's high chances you are going to see more of TPs than SL. And that's what we want to do at every point in time as traders. As long as we have more TPs than SLs, you will come out head and shoulders above the C level. You will succeed as a trader. Now, looking at this chart on gold, right? If you're looking at this chart on gold, and it's quite obvious that gold is actually bullish, right? Then you're looking at dynamic supports dynamic. In fact, since the market is bullish, you're working with dynamic support. So where exactly do we expect what we are seeing right now to end on gold? So that's where you now start putting your trend lines. So how to put a trend line is that you connect two lows. These two lows. This is the first low, this is the second low, and you extend it into the future. Brilliant. Okay. You extend this into the future. So you expect that this market, the correction may actually get to somewhere here, right? Comes to this. Now, if you're looking at the most immediate price delivery on this market, you're going to see that from here, the market entered serious bullish zone. So any two lows, you can actually connect with a dynamic line, we form a trend line. All right. So we had this low, and of course, this third one. So we connect this and project it into the future. You now see that right now, I think gold is testing a very key level in the market. Okay, so this trend line right now, you're seeing this is the first touch, second touch, first touch, second touch, and of course, the third touch was where the market moved from. All right. So on this third touch, the market moved. Coming back to it, the fourth touch, we saw the market broke it. All right. So if you're going to continue going down, two things are possible. So that we see this market, from here depletes, comes back to this zone, and come back to retest this before continuing to the downside. Or in the event that we see close above this, that we are now facing upside. Either of these can likely happen, right? Now, but how you use this is most times, right? The market come back to this, you'll be looking for reasons to buy. Okay. So just like here, all right, you have first touch, second touch. On the third touch, you're going to be modeling buy orders, right? It's very important. I always tell students when I have opportunity is if you're trading trend line, you're using it to model trade. Only trade the third touch. For me, that's the only thing I trade. I don't care how many times the market have respected the trend line. If I miss the third touch, I'm no longer trading it because the third touch has the highest probability, and most times the chances of the third touch failing is almost like impossible. Like most times, over 80% of the time, the third touch doesn't fail unless it did not mark the trend line very well. You get? So, but most times when they liquidate, you start hearing about trend line liquidity, trend line didn't work, is after the third touch, because it's after the third touch that a lot of traders start seeing that there's a trend or there's a trend line existing. And that's the zone where the institutions will want to run liquidity and take your money from. So after the third touch, you're no longer interested. Okay. Now, if you want to frame an A+ setup, there are confluences you need to see. You need to use the confluence of dynamic and static. When you have a dynamic support or resistance in line like this, let's say this is the dynamic support, and you now have a horizontal support and a dynamic support coming in confluence. So let's say the market have actually been bullish, right? Market has actually been bullish, going up like this, and eventually we saw it take out this level, right? It closed above this resistance zone and started going up. As the market was going up, after breaking this resistance, most likely you're going to see a retest. Market has to come back to retest this resistance as the new support. If you get set up somewhere around here where you have the confluence of dynamic support and dynamic resistance coming in together, is going to give you an A+ setup. this kind of setup is setup that's actually is a setup that will work. In fact, it works over 80 to 90% of the time. When you have a dynamic support, a dynamic resistance coming in confluence with dynamic support or resistance. Most of the time, you're going to see this market bounce from this level and start going up big time. Okay. The reason is there is dynamic support working against price, preventing price from going down. There is horizontal support and resistance. Horizontal support preventing price from going down. So you have two forces acting on price to go up. All right. The signal is much more stronger than when it is only one force that is on that, trying to achieve that objective. Okay. So this is basically how to do it. I urge us to go through our charts, go through charts, draw all this. Whether you trade SMC, you trade support and resistance, you trade the demand and supply, you trade ICD, you trade indicator, even no matter the strategy, with the help of support and resistance on your charts, you're going to increase your win rates a whole lot of times. All right. So for those of us that were in yesterday's class where we talked about candles, where you'll be looking for those candlestick patterns are on these zones. If the market is not on these zones, no matter the candle it prints, you don't respect that candle. The way you need to see those candles is on zones like this. All right. If the market has printed a good candle here, we would have bought here. Let's say as the price got to this price level here, we saw a hammer candle. We would have placed a buy here straight today. But there was nothing like that. All right. Now, if you look at these zones where we have price reacting from, all these important zones, see that there are signal candles on this zone. After the markets come to this level, see it printed this giant spinning, giant shooting star, came back, repeated it, and the market dropped. The same thing here, you saw market coming back on the zone again. It printed this shooting star. Now we looked at the family pin bar. The pin bar looked at the pin bar family of candles yesterday. And we said that the two decision candles we have is the shooting star, and we only want to see it as resistance for us to sell, and the hammer as support for us to buy. Equally talked about the engulfings, all right? You see when the market came back on this zone, no signal to buy, no signal to buy, but this is where the signal came. We had a bullish engulfing here. And shortly after this, you see the market rally to the next resistance zone. So that's basically what we're saying, that you only look for these guys at strategic points in the market. If you come to this zone, you see the market printed a spinning, a shooting star, then engulfing, market dropped. You go back in time too, you're still going to see this. So what we had there is bearish engulfing, market went down. The same thing here. We have bearish engulfing here. The markets, this price engulfed this, and you see it sold off. So if you can't use candlesticks to trade the market as single or in isolation or just a standalone strategy, you need to combine it with support and resistance. Honestly, if you combine these two forces, just these two concepts alone, right? You are going to be successful as a trader. Quote me right, because the market knows this like no man business. All right, it works all the time. Okay, guys, time for questions. If you have any question with respect to what we've discussed today, it's time to ask. All right, so you can unmute yourself right now, ask questions.
Hello, sir. Good afternoon, sir. Thank you for this wonderful teaching. Thank you so much for this wonderful teaching. Just like the previous person said, please, sir, I would like the recorded message, because some of us, we are new to Forex. It's our first time, so a lot You have taught us a lot, and for us to understand it much more better and also practicalize it is if we get access to these videos, the recorded ones, so that we can go through it in subsequent time, please. Thank you so much.
All right.
And
Okay.
sir, please, I want to ask, these drawings you do on the charts, those using phone like me now, can I also do the drawings on chart?
Yes, you
On my
can.
chart through the phone?
Yeah, you
Through the
can do
phone.
it.
Okay.
Yes,
Okay.
you can
All
do
right.
it, but just that it's a bit more stressful on phone than system. But you can still do it.
Okay. Okay.
All right.
Okay, sir. Because yesterday you taught us how to install it in our system, which I've done. But most of the charts, I'm not seeing it on my system yet. So I don't know. Yesterday we were very fast. So I was trying to meet up, but I got to some level and I stopped. So I don't know if today, before the end of the teaching, we can help us go back a little so that we can put it together. Thank you, sir.
All right.
Good afternoon, sir. Can you hear me?
Yes, sir.
Thank you so much, sir. Sir, please, my challenges is when drawing the support and resistance, are we going to draw it from the wick or we should include it with the bodies, like the body of the candle?
Okay. So the way I do it, I try to ensure that the wicks are all covered. So let's say, for instance, let me show you something. I'll start from the formation, more especially the closing of the candles. Where did we start that drawing from? Okay, here. Yeah. Now, if you look at this zone, I'm going to take out this out. Take out this. All right. Now, if you look at the price delivery here, you see that I'm going to first catch the wicks. This wicks. This is the first one. You see that this one didn't get here. The second one did not get to this wick. All right. The second one didn't get there. The third one did not get there. All right. Then I will double this line. This is the highest. Then I will start with this one. It catch the most reaction. But you see that the rejection is still got to this place. And I will now extend it to the starting of this candle. You see from here now, you see that this other candle closed here. The next one started. So I will include this guy like this. This is where I like to do it. So I'll put it at this key level. You get. With this now, you know that this place is covered. There is this body of the candle is there. This is the highest the market traded before reversing. And they found support at this key level. At the close of this candle, the market found serious momentum to the upside. Okay. So the open and close of this candle is what you now use. You get. The reason is if you do it just like this, right? Only these weeks, this market can come back to this price from here. You come back after it has gone up, go to this place and move. And in your mind, you'll be like, it has not gotten to the support zone, but it has already mitigated that zone. You just come here and go. And you'll be wondering, you still be waiting, and you see the market delivering the pips, and you're not in the trade. The key level that initiated that move